The gentleman from Minnesota, Mr. Paulsen, recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to thank both of you for taking the time to testify here again today. Chairman Bernanke, a document that you sent to the Senate Banking Committee contains the statement, "We recognize, of course, that bank supervision, including ours, needs to be more effective than in the past, and we have reviewed our performance and are making improvements at multiple levels." And I just came from a meeting with a bunch of local bankers from Minnesota, and they talked about how they've got money to provide for credit, and they want to lend it out into the market, and their overwhelming concern was in regards to the uncertainty or the inconsistency that is being created by the regulators, the OCC, the FDIC. And these regulators are being inconsistent in the sense that when they come in and visit with the banks, from visit to visit, their demands essentially are changing, and they're preventing good loans from being continued or from even being made in the first place. And I know we had a hearing in this committee along with the Small Business Committee just a few weeks back, and I think every single member, nearly every single member of this committee raised this issue. And the FDIC and the OCC responded essentially by saying they have told their people in the field to kind of take a step back regard to what is actually happening. But I think there's still a disconnect that's going on. And so I'm just wondering, knowing that I met with 30-some bankers, and it seems like nothing has really changed in recent times regarding the examinations that are going on with the banks, what can the Federal Reserve do better to handle this issue and create some consistency for the bankers that so more credit is available to be put out into the market?
This has been one of our top priorities. It's very, very important. You know, what you need to do here is get an appropriate balance, on the one hand, between making sure the banks are safe and sound, making good loans, on the other hand, making sure that credit-worthy borrowers can get credit and that the economy can grow. So we need to find the appropriate balance there. And we've done that in a number of ways. We have taken the lead on issuing guidance to our examiners and to the banks on small business lending, on commercial real estate lending, where the emphasis is on finding that appropriate balance and giving lots of examples to the banks and the examiners where you can look at the example and it tells you, gives you some insight into what criteria to apply when you're looking at a loan. And in particular, one point that we have made repeatedly is that just because the asset value underlying a loan, the collateral of the loan, has gone down, doesn't mean that it's a bad loan, because as long as the borrower can make the payments, that still can be a good loan, and we shouldn't penalize the banks for making those loans. So we have issued those guidances. We have done an enormous amount of training with our examiners to make sure they understand it. We have been gathering information and feedback from the field, including asking for more data and more information, but also having, at each of the reserve banks around the country, having meetings that bring in small businesses, banks, community leaders to try and get into the details of what's going on. We've also tried to support the small business lending market with our TALF program, which has helped bring money from the securities markets into the small business lending arena. So it is a very important priority for us. We were asked before about the interaction between being the macro, being responsible for the macro economy and being a supervisor. Well, here's one case where knowing what's going on in the banking system is extremely important for understanding what's going on in the economy broadly, and we take that very seriously. So, you know, I realize it's still an issue. It's going to be a concern because certainly standards have tightened up. Certainly some people have, who were credit eligible before are no longer eligible because their financial conditions are worse. But we really think it's very important that credit-worthy borrowers be able to get credit, and we're working really hard on that.
And Mr. Volcker, can you add some comments on that based on your history?
I'd be glad to add a comment, because I think this is an old problem. I remember when I was a young fellow learning about the Federal Reserve, the long-standing chairman of the Federal Reserve in the 1930s was one Mariner Eccles, who repeatedly complained in the 1930s, in the midst of the recession, that the sole responsibility for banking supervision and other agencies, they were being too tough because they'd had a lot of losses on their watch, and they were overreacting in terms of strict regulations at a time was inappropriate because the economy was mired in recession. There have been other times when, if you're just looking at banking regulation, that's your only responsibility, maybe you're going to be too easy when things are going very well and the economy is on the verge You know, the party's getting a little too ebullient. I think really that the Federal Reserve is in a better position to get a balanced regulatory position, a regulatory approach, simply because they are responsible for monetary policy and responsible for business activity too. That is one of the strengths in keeping the Federal Reserve in the regulatory business, in my view.
Gentleman's time has expired. The gentleman from Georgia, Mr.